Hey guys, I hope you and your families are doing well. On this channel, we talk a lot about swing trading, breakout and pullback setups, but what we rarely talk about is market timing. So I'm going to show you two key breadth indicators that I look at. Now these aren't complicated, it's very simple, it's overbought and oversold territory for both of them, but they really help me identify when I want to be involved in the true market leader type stocks, the NVDAs of the world that have huge earnings, huge sales, big estimates, global product involved in a new revolutionary technology being artificial intelligence. So it can really help with the trade management side of things. So we'll go through NVIDIA a little bit later on and I'll really explain the thought process for when I want to be identifying and getting positioned in these kind of stocks, but also helping me from a trade management standpoint, understanding the breadth of the market. So I think this is going to be a little bit of a game changer actually in terms of how you go about viewing the market, really thinking about the timing of your entries and also the timing of your exits as well to go alongside your selling rules and selling guidelines. MarketSmith are today's video sponsor. If you're interested in a discounted trial, then there is a link in the description and comment section below. So I'd like to spend 30 seconds at the start of this video just outlining and showing you the slides that we're going to be working through. Now a lot of this is going to be very unfamiliar to you and how to use it may be unfamiliar as well. But by the end of the video, I really do hope you understand this in terms of helping you time the market, time entries, time exits a bit better in your positions, and it does help you with your trading. So this is going to be the first slide that we're going to go through. This is S&P 500, stocks above the 20-day, the 50-day and the 200-day, and I'm going to teach you about the ebb and flow of the market but across different durations. We're then going to go more tactile and I'm going to show you correlations. So we're going to overlay the S&P 500 with the S&P 500 stocks above the 20-day moving average, and I'm going to use the analogy of the tide comes in and the tide goes out. We're then going to repeat that exercise for the NASDAQ 100 overlaid with NASDAQ 100 stocks above the 50-day moving average. We're then going to zoom out and we're going to go S&P 500 stocks above the 200-day moving average, and I'm going to teach you about negative divergences as well. And then to finish, I'm going to teach you about the McClellan oscillator, which I use in conjunction with these breadth readings. So let's start here on this slide, okay? So I do this analysis for the NASDAQ 100, I do it for the S&P 500 and the NASDAQ comp as well. So we have here the S&P 500 stocks above the 20-day moving average. In the middle we have S&P 500 stocks above the 50-day moving average, and down here on the bottom we have the S&P 500 stocks above the 200-day moving average. Now what I'll do is if you want to get these tickers into TradingView, I'll put them in the comment section below. So the same tickers for the NASDAQ 100, S&P 500 and NASDAQ comp, they'll be in a comment somewhere below this video. So we need to understand that the market is a mean reverting machine, okay? It mean reverts. To use a nice analogy, which I think may work, if you think about the tide comes in and then the tide goes out. So we want to be aware of when is the tide in and when is the tide out, because the market will mean revert. That is what the market does. You can see the ebbs and flows here. So this is overbought territory, oversold territory, overbought, oversold, overbought, oversold, so on and so forth. And it happens across different durations. So that was obviously the 20-day. We can see it with the 50-day as well. So the tide is in very far, and I'll explain what very far is in terms of the percentages to be looking at. So the tide is in very far here. Over 75% of stocks in the S&P 500 are above their 50-day. That is, the tide is in overbought territory, and then it transitions, so it then mean reverts to oversold territory, which is less than 25% of stocks in the S&P 500 are above their 50, and then it mean reverts. So this is about understanding kind of that tidal nature. You see the waves are coming in, the waves are going out, the tide comes in, the tide comes out. Livermore spoke about this in his books about trying to understand the market's next swing of importance. Now the swings of importance can be across different durations as well. If we then take a look at the S&P 500 stocks above the 200-day, you can see the mean reverting nature. So overbought territory to oversold to overbought to oversold to overbought. This is what the market does. Now, why is this useful? Well, it's useful for us to know that, okay, the majority of stocks are probably going to follow whatever the index is doing. So if the indexes are generally rising, so the tide is coming in, that rising tide lifts all boats. Vice versa, when the tide is going out, the leading stock of the day is then going to be swimming against the tide. We want to have the tide on our side, but we need to be aware that there are different tides across different durations. So this is where we're going to add a little bit of mental complexity here. So you're going to have to stay with me, because you can have signals which are different. So you can have that the 20-day the 20-day reading is potentially oversold, like down here, but you have the 50-day reading is overbought and the 200-day reading is overbought. So you need to be aware that there's three different tides. There's the 20-day tide, the 50-day tide, and the 200-day tide, and sometimes they may be telling you different things. So I do this analysis for the NASDAQ 100, the S&P 500, and the NASDAQ Composite as well. So this then helps me better kind of time the market. What do I think the market is going to do? What is going to be the next swing of importance across these different durations? So you may be going, okay, that's all nice, but how does that actually work in reality? Well, let's go through it, okay? So this is the S&P 500. Now we're going to start here looking at it as a bullish perspective. So this is when the market, in the terms of the 20-day reading, is oversold. So we'd be looking for the market to bounce. Now this is then helpful with timing entries, because if the market is then going to transition, so such as you can see here, so late-ish May, so 25th of May 2023, if the market is going to do this and transition from oversold to overbought, we'd be expecting the market to rally, which rising tide lifts all boats, right? So this is where it's helpful, I think, to be real dialed in on the leaders. What stocks, as the market has been correcting or consolidating and you've seen the deterioration in breadth, what are the leading stocks, those NVIDIAs of the world or whatever they may be, those leading true market leader, the O'Neill type stocks, big earnings, big sales, big estimates, global product, new revolutionary technology, huge estimates, institutional liquidity as well. What are those stocks that held up really well during the market correction, during the market pullback? Where was the relative strength? Where was the relative strength in terms of the group? Because if the market is now going to have a run for 3 weeks, 4 weeks, 5 weeks, 6 weeks, whatever it may be, from that oversold territory to overbought territory, what are the leading stocks we really want to be involved in during that time where the tide is coming back in? Now we then want to be aware of it as well and be looking for change of character type behavior, which I think I covered in the most recent YouTube video, that change of character type behavior that I call bearish synchronicity, what distribution looks like. So when the market is in these oversold territories and the tide is out and we're expecting the tide to move back in, I'm on the lookout for type of candlesticks. Okay, I'm looking to look out for shakeout demand tails, gap down reversal bars, signs that institutions are stepping back up, and then vice versa. When the tide is in and it's then overbought across these different durations and it's overbought, I'm looking for the change of character. I'm looking for bars like this that I call bearish synchronicity, slicing through key moving averages. So you want to be on the lookout for kind of key accumulation candlesticks, shakeout demand tails, gap down reversal bars as I refer to them, when the market is oversold, so the tide is out. Why? Because the next move of importance, we think the tide is going to be coming back in. So then we can try and get ourselves positioned, as I clapped that, I don't know why I clapped. So then we can try and get ourselves positioned in the NVIDIAs of the world, the CrowdStrikes of the world, the Broadcoms of the world, the Meta, whatever is the leading kind of institutional type stocks of that period in time. What are the ones that displayed the best relative strength? So you can see the correlation here, right? Okay, and I hope that the tide in, tide out analogy is helping you and going, okay, interesting. Now, is absolutely perfect? Absolutely, it's not perfect, but this just helps me kind of dial in and focus. Okay, what am I seeing here? Am I seeing that the tide is out relatively far here in terms of the reading here? Percentage of stocks above the 20-day moving average for the S&P is less than 25%. Okay, the tide's out. I'm expecting the market to mean revert, because that's what the market does. The tide goes in, the tide goes out, the tide goes in, the tide goes out, right? So I'm then looking for, okay, what are the leading stocks setting up maybe around this time here? Because then I'm expecting the market to potentially have a run for maybe it's 2 weeks, maybe it's 4 weeks, maybe it's 6 weeks, depends. Are we then seeing an oversold reading on, say, the 50-day moving average as well and the 200-day? That could mean that there's a big tide coming back in. So the 20-day is going to be the smaller tide, is a little bit more tactile, right? But you can start seeing the correlations. Now, I will just briefly touch on it here, but I really want to go in depth when we go into the 200-day moving average reading and for the S&P, right? Is negative divergences. You want to be on the lookout for when the market is making a higher high, but breadth isn't confirming that. So breadth is actually making, the 20-day reading is actually making a lower high, whereas the index has made a higher high. So that can indicate just underneath the subsurface, actually there's a bit of weakness there. Vice versa, if you see that the index makes a lower low, but the breadth reading makes a higher low, that would be a positive divergence. So we want to be on the lookout for those. So let's just do another one. Again, reps and sets here I think is going to be useful for us. So now we're looking at the NASDAQ 100, okay, NDX is the ticker, and we have loaded up on the bottom the NDFI, so that is the NASDAQ 100 stocks above the 50-day moving average, okay? So under 25% the stocks of the NASDAQ 100 above the 50-day is going to be oversold territory. The tide is out quite far. If it's 75, so this reading here, these are percentages. I know they're shown as just numbers here. Think of these as percentages, okay? So 75%. If we get 75% of NASDAQ 100 stocks above the 50-day moving average reading, it means the tide is in quite far. Okay, the tide's in. It's probably not going to go much further in. Certainly if you start getting readings up in like the 90% plus. Okay, the tide is in quite far here. So this is how we think about the next swing of importance. So the next swing of importance, Livermore, just absolute trading genius, would talk about, and he spent a lot of time thinking about, okay, where is the next swing of importance for the market? Where do we think it's going to be? Do we think it's going to be to the upside? Do we think it's going to be to the downside? This can really help with a trade management perspective as well, because like I showed you with NVIDIA, okay, NVIDIA started topping out around this time here in July. Okay, this is where NVIDIA was then topping out. I showed you a little bit earlier on. So then I know with NVIDIA, okay, we're overbought here in terms of a 50-day reading. It doesn't have much more, like the market doesn't have much more room to come in. It's already in pretty far. Certainly if you start getting breadth readings up in like high 80% into the 90%. The next move of importance is probably going to be to the downside here. So then we're aware of that from a trade management standpoint. And again, if I'm then thinking about, okay, leading stocks of the day, whether that be, let's just use NVIDIA for instance, okay, because it's like the institutional TML type stock. When do I want to be? If I'm trying to like swing trade it for a really big move and I'm like thinking, okay, coast to coast, it's basing around its 50 and maybe I want to hold some back till it close below its 50-day moving average, I probably don't want to be loading up on NVIDIA when it's here. And the market, in terms of a breadth standpoint, is in overbought territory. Why? Because the market's probably not got much more room to go. When the tide starts coming out, NVIDIA is very strong, but is it really going to be able to swim hard against the tide? It may show a lot of relative strength and be able to base, build higher lows, set up around key moving averages, but in terms of trending up, you'd expect those trends more so to play out when the market is oversold and or near oversold and then transitioning to overbought. Okay, tide goes in, tide comes out. Tide goes in, tide goes out, and vice versa, okay? So we want to be aware of that. Now, right now as well, you've had the NASDAQ 100, so the Qs making a all-time high, but you can see the negative divergence. This just puts me a little bit kind of cautious here. I'm like, okay, overbought, we're in overbought territory. We can see that, plus we've got a negative divergence. Do I want to be loading the proverbial boats on like the Ubers and the NVIDIAs of the world right now? Probably not. I want to be waiting for that transition, that mean reverting nature of the market to come back down to oversold, see what are the stocks that display tremendous relative strength, like I just talk about in other videos. So that's really kind of the setups, but then there's a time of when I want to be targeting the setups and when I want to be pushing the exposure hard, because you can see up here, right? So we were looking at the S&P on the previous slide. We were looking at, okay, oversold territory, so we're expecting the market to be then coming in, but then you can see the correlation of the overbought, right? We can see it in here in mid-August, we can see it here in early December, we can see it here in mid to late July as well. Okay, and you can see what the market did there afterwards. Okay, you can see what the market does. Now, does it do it perfectly like this every single time? Absolutely not. If you're looking for a holy grail and a magic indicator, you're not going to find one. Sorry to burst your bubble. You're not going to find one. But this here helps me to, okay, dial in. Where do I think the real strength is in the market? Where do I see the leading stocks? And ideally, I want to be loading up on those leading stocks if I want to try and play them for big moves. When the market is near oversold territory or in oversold territory, then take advantage of that. Okay, is that making sense? So when the tide goes out, that's when I want to be, okay, where's the relative strength? Now this is when most people are bearish. Okay, when you look at financial media, guess what? When the market's down here on the lows, it's actually putting in like a bit of a treble bottom type pattern down there. But either way, okay, when the market's down here on its lows and you're starting to get these oversold readings, when do you think mainstream media is going to be most doom and gloom? You got it right there at lows. But what's the market indicating to you? What's the market saying to yourself? So hopefully with this newfound knowledge, you'll just focus on the market. Okay, what's the market saying? What's the next move of importance here? Now, obviously, can oversold remain oversold for a long period of time? Absolutely. Can overbought remain overbought for a long period of time? Absolutely. As I said, there's no holy grail here. There's no holy grail, but I find this a very useful tool in terms of my analysis of the US markets. Now let's go here. So we're going to zoom out here, okay? So this is the S&P 500. So as I said there about 30 seconds ago, can oversold remain oversold? Can overbought remain overbought? Yes, it can. So this is the S&P 500 on the top, and the S&P 500 stocks above the 200-day moving average reading, 200-day moving average on the bottom. So it's the same readings, okay? 25% and 75%. Let me show you guys how to set this up. I meant to do that a little bit earlier. So you can go and find the tickers. I'll put them in the comments down below, okay, for you. Okay, come on to the chart like this. You can split the charts, whatever you want to do, right? If you go into, if you're a member of my platform, there's an importable link with all of this stuff as well for you to save you a little bit of time. But if you want to set them up yourself, okay, you can do it like this. You press Alt-H like that to put a horizontal line in, and then you want to move this to say 25 or 75 like that, and then the style you can make it green, pink, blue, whatever you want to do, okay? Then to get this shading, there's no indicator, you have to do this manually. So what I'm going to do here is select the rectangle like this, and then I'm going to put the rectangle on, double click on the rectangle like this, and then to do the top one, okay, we'll do it in red. If you want to make it a different color, make it a different color. So I'm going to make that red, go to the coordinates, and then what I want to do is I want to go 75. I then want to go 10,000 like this. I then want to make this, I want to make this 1,000 as well, or 10,000. And then this one here, I want to make this minus 10,000. If you set it up like that, then that there will put it the shading like that. If you want to do it for the green zone down below, let me show you how to do that. So we'll change the style to green like this, go to coordinates. This time you're going to want to do 25 there, and then down here you're going to want to do minus 10,000 like this, and that'll put it down there like that to do the shadings. Now, if you want to then set this up for percentage of stocks about the 20-day, 50-day, and 200-day across those different indexes for NASDAQ 100, S&P, NASDAQ comp as well, you have to repeat this exercise. You have to do this 9 times. In essence, there's no shortcut to do it, but that there is how you do it, right? Let me go back to the point that I was making. So you can see overbought, remain overbought for a long period of time. As I was saying a little bit earlier on, you want to be aware of positive divergences, but you want to be aware of negative divergences as well. So you can see here with the S&P 500, generally speaking, it's making a series of higher highs, higher lows, higher highs, higher lows, bit of a correction there, but overall higher highs, higher lows, right? But what do you see in terms of the breadth here? So this is S&P 500 stocks above the 200-day. So it's up here around about 96%. That is a very, very, very high reading on a historical basis. As I said, when you start getting into the 90%, whatever it be, 20-day, 50-day, 200-day moving average readings, you want to be aware of that. But what do you then see here for breadth? Well, we see here lower low, lower high, lower low, lower high, lower low, lower high, lower low. Okay, whilst the index is doing the opposite. So this is a deterioration. This is a negative divergence. So if you think about the avalanche, the last thing to move is the surface. So the surface that you can actually see, the snow on top that you see, that's the last thing to move. It's actually the underneath the snow. So it's the subsurface that starts to erode and go first. So this can just help you if you start to see these negative divergences. It can help you. For me, I find it a very useful tool in my analysis, both looking for positive divergences, but also negative divergences too. Now, what I want to do here is actually just zoom in a little bit for you guys. So let's zoom in. Hopefully I'm not blocking anything. So so 2023 into 2024, right? We want to be aware of things. Now, can you add, say, seasonality? Maybe I'll do a video on that in a couple of weeks. So seasonality as well. So understanding from a seasonality perspective the character of the market and what it is you're expecting. Again, you can overlay a lot of things here. Also, a really important thing is, what are you seeing in terms of the market leaders doing? Right now, what are the NVIDIAs doing? What are the Broadcoms doing? What are the Metas doing? What are the CrowdStrikes doing? What are the Ubers doing? What are those kind of stocks doing as well? Are they basing constructively? Are you seeing distributional characteristics? Are they slicing through key moving averages? Change of character, lower lows, lower highs, getting sold into, gap ups, getting aggressively sold into on high volume. What are you seeing there for the leaders as well? It's never just one thing, but this is a useful thing as well, especially when it's like down on the lows like this, and like you turn on like financial media. I don't listen to anyone or watch anything, but I presume if you turn on financial media right here, again, you're reading articles and stuff like that, guess what? They ain't going to be positive. But that was the exact time to be positive. Make sense? So here, we want to be aware of these correlations. So we can see here, in early February, okay, we get this overbought reading in terms of S&P 500 stocks above their 200-day. So what does this mean? 75% of stocks in the S&P 500 are above their 200-day moving average. Now that is going into overbought territory. Can it stay overbought? Absolutely, it can stay overbought, but we want to be aware of that. It doesn't mean that I panic and, right, I'm exiting all positions. I'm aware of it. I'm aware of it. I'm then on the lookout for distributional characteristics. Certainly if I then see, wow, 20-day, 50-day, and 200-day are all in overbought territory, I'm on the lookout for potential change of characters, stocks slicing through moving averages that I may be in. Okay, it's now violating my sell rules. Okay, I'm exiting this much of the position. I'm out of all the position. It depends, right? That is the nature of selling rules and selling guidelines. But if you are overbought across all 3 durations and you're seeing it for, okay, NASDAQ 100, 20-day, 50-day, 200-day, everything is overbought. S&P 500 is the same. NASDAQ comp is the same, everything's overbought, then guess what? I'm going to think that tide is in pretty far. The market does not have much more running room to go on a historical basis. Can it stay overbought? Can that tide stay in for a long time? It can, but it can also go out quite quickly. And the market tends to go out quite quickly. Okay, the market gets quicker and quicker and quicker. Vice versa, if I see, okay, S&P 500, 20-day, 50-day, 200-day reading, and the NASDAQ 100 and the NASDAQ comp, everything is in an oversold territory. What's that telling me? The tide is out quite far. The next swing, the next move of importance, I think is going to be the tide coming in. Okay, what are the leading stocks? Are they setting up as per my criteria? And then potentially I want to be more aggressive, potentially holding NVIDIAs for the likes of 50-day to 50-day and waiting for closes below 50-day, certainly if we see like the S&P 200-day moving average reading is in oversold territory, maybe NASDAQ 100 as well. Why? Because this is the point here, okay? The market has running room. The tide can come in a long way. So you see this here, okay? 30th of October, so late October, it registers that oversold reading. It's right there. And now look at the move in. Okay, but breadth was indicating here. Does it have to happen like that? It doesn't have. There's no, I emphasize this, there's no magic pill. There's no holy grail. If you're expecting this to be the holy grail, it's not. It is a very useful tool in my analysis though, because it then really helps me from a trade management perspective. Because if I'm here and then I start to see, oh, okay, change of character, potentially gap down, reverse bar, big volume coming through, the stock aggressively pops back up through key moving averages, widespread, gap up, open on a low, strong close. A lot of TML type stocks are breaking out of continuation bases that may be like 4 weeks, 8 weeks, 12 weeks in duration. Okay, the market's got some running room here. That's then what I'm looking for. So it really is useful in terms of timing. And right now, when you take a look at it, S&P 500 stocks above the 200-day, well, what do you notice? Okay, overbought territory and starting to get that negative divergence. The index has made a higher high into an all-time high, but yet breadth is not currently confirming the move. Now, can it turn around? Yes, but you want to be aware that, okay, we just registered the overbought reading here. Okay, what is potentially the next move of importance here? And again, we can then factor in seasonality and other things like that. Now let me also show you the McClellan oscillator. So the McClellan oscillator is a breadth indicator that I like using, which is looking at net new highs and net new lows. Okay, if you want to go and find the complicated formula for how it's calculated, just go and Google it. You'll find everything's on like Investopedia or something like that. Okay, but you want to be aware again of the breadth, the breadth readings. So 20-day, 50-day, 200-day across those three major indexes. So NASDAQ 100, S&P 500, NASDAQ comp. But the McClellan oscillator is then a useful kind of cherry on top, because you'll see it doesn't do it perfectly. Again, there's no holy grail out here. Okay, there's no holy grail. There's just useful tools. I find this a useful tool in my analysis, certainly using the McClellan oscillator more so from an oversold reading. Okay, oversold down here. I may be blocking this one depending where the webcam goes. Okay, oversold here. Oversold here, and most recently oversold here as well. So I'm then looking for the market to bounce. So if I just zoom in to this most recent one, okay, you get a shakeout demand tail that's a higher low in potentially a continuation cup and handle type base, and you've just registered an oversold reading on the McClellan oscillator. You guys see this? Look at this here, okay? This is a shakeout demand tail that I talk about to the 21-day EMA, and you also had a lot of TML type stocks. So you're what was setting up around this time? Ubers were, CrowdStrikes of the world, where there were a fair few stocks setting up around this time, heading into this session and the next session as well. IGV looked pretty good, software ETF, SMH looked pretty good. You had the S&P 500 also putting in a shakeout demand tail to its 21, putting in a higher low, and then you go and register this oversold reading with the McClellan oscillator. So I'm then going to give that more weight. Okay, McClellan oscillator oversold, so similar to what we were talking about with the breadth stand, the breadth readings there with the moving averages, I now think the McClellan oscillator, that proverbial tide is out. The next move of importance for the McClellan oscillator is I'm expecting the tide to come back in. So this then helps me in terms of my exposure to the market and how aggressive do I want to be with entering new positions, or do I just want to kind of chill out and wait a little bit. So I find it a really useful tool in my analysis as well, combined with other things, combined with the actual price action, volume action of what am I seeing in the indexes, what am I seeing in the leading stocks. So this is then why on charts like NVIDIA, if we now just circle back to the beginning here, right? We now just come back here with NVIDIA. Okay, when NVIDIA starts getting up here into this territory, which is then this territory, what am I thinking? Well, the NASDAQ 100 stocks above the 50-day moving average reading, they're in overbought territory. They're nearly at 90%. So up here, what am I thinking? I'm not thinking NVIDIA is going to push another 50%. I'm thinking NVIDIA is probably going to base. Can I stay in it in terms of the basing period, assuming my sell rules are not violated? So I then kept back a third for NVIDIA around the 50-day, and it closed below the 50-day. I gave it every chance, adjusted my stop loss underneath the low of that bar for the final third, and then I get stopped out there. But then you can see the deterioration in breadth. The next move of importance, next swing of importance for the market was going from overbought back down to oversold territory. But if you look at when the entry was, well, 50-day moving average reading for the NASDAQ 100 is like mid-range. It's like 50%. Okay, what is that telling me? Well, I've got a TML type stock that showed a lot of relative strength, and now I don't have the volume of the RS, otherwise the chart would be just really compressed it. But what I have here is a TML type stock, huge earnings, huge, all of that stuff for NVIDIA, right? AI, all of that good stuff. It's building an optimal basing type pattern. It's pulling into the 21-day MA. It's tight, favorable initial risk versus reward trade, 2.25%. Obviously, the final third up here sold at 50%, so many multiples of that. It was a good trade NVIDIA, right? But then it helps me from a management standpoint because I'm looking at the breadth. And I'm doing this for 20-day, 50-day, 200-day. Okay, I'm looking at the NASDAQ 100, S&P 500, the NASDAQ comp, and I'm going, market's got running room here to the upside. If NVIDIA wants to start breaking out, there's running room here from a breadth standpoint. So I'm going, yeah, the tide is only halfway in or so. Okay, this is kind of like halfway in. Okay, it's maybe not quite halfway in. Okay, so I'm going, okay, 25% would be, that tide is out really, really far. And then 75%, I'm like, that tide is now in. Like leading stocks, market, they probably don't have much more running room here. Okay, so it's really important. So here, when I'm then targeting NVIDIA, I'm going, yeah, there's running room here. If NVIDIA wants to move, the market will allow it to move. I think there's running room to the upside here before that tide really starts getting in. But then when you start getting these oversold readings, overbought readings in terms of 20-day, 50-day, 200-day moving average readings, I'm more tactile. So I'm more so focused on the 20-day and the 50-day, but I'm very aware of the 200-day. When I then start seeing closes below, say, 10-day EMAs or 21-day EMAs and that kind of like change of character, if we're then in overbought territory, I'm going to give it more weight. Okay, so this is how it just gives me a bit of a better feel for the market. So I'll wrap that video up there, guys. Very different to what it is we usually cover on this channel. As I said, there are going to be ticker symbols below if you want to go and import them into TradingView. I showed you how you can kind of mark them up like this as well. I would turn all the moving averages off for them, and I would also do it on just arithmetic scaling. If you put it on log scaling for these for these breadth readings, they go a little bit kind of all over the place. So I would just prefer it on arithmetic scaling, and then also auto fitting to the data like that. And I think it'll be useful for you. But yeah, any questions, let me know in the comment section down below. Thank you very much for supporting the channel. Certainly if you made it to the end of this video, I really do appreciate it. If you could subscribe, like the video, it really helps me to grow the YouTube channel. So thank you very much for watching, and I will see you in a future video.